Okay, now I have given you a set of notes which will last us a couple of classes. Okay, so some of those things you can run through. Alright, now is this the first time auditing? First time? First time? Anyone with auditing experience? No, none of you are working in the auditing line. Okay, right. Now, so just a little bit of this paper that we're gonna have. Now, I will not run through what's in the syllabus since it's first time, right? And Bell also you may not know. Now, all the F paper will now have MCQ, as you read. Okay, so same goes with F8. We also have MCQ, but the MCQ section for F8 is a bit lesser. We have less mark, which is only this 20 marks over here. That comes with 12 questions. Alright, now why 12 questions? Because it's very funny. They have 8 questions with 2 marks. They have 4 questions with just 1 mark. The 1 marks are either A, B, C instead of A, B, C, D. And then sometimes they will give you questions with like true or false kind of option. Okay, now so this is section A. Now then we have section B with 6 questions, short and long. Okay, so now all these things is how the format is going to be. Now we will see more of this when we look at the past year, which is not so soon. So as I go through, I will bring in some example of questions and discuss and show you how to write the answers. Okay, now so let us start with this thing today. Okay, we're going to begin off with this part. Now as usual, at any time when we start with the topic, it's important you must get an idea like what is this. Okay, so if you do not grasp what is this issue, then you're going to find it difficult to follow. Okay, now so what we're going to do now is to introduce you what exactly is auditing. Okay, if it's only 5 students, will you all talk to me? No. You see the problem. 50 students also they don't talk, 5 students also they don't talk. So end up I be talking alone. Okay. Now don't feel bad. Don't feel bad. Okay, so we try to communicate more, so it's easier for you. If not, you're gonna feel very hard to go on. Okay. Now, so what exactly is auditing? See, whenever I ask students like, what do you mean by auditing? They will have in mind is like some kind of checking of accounts. That's called auditing. Okay. So they will have perception. Audit is checking of accounts. Now, is it true that auditing is checking of accounts? Now, technically, no. Alright. So what we sell is not checking of account. We are selling opinion. Okay. So checking is the service that we provide, but what we're selling here is an opinion, because we are not giving people checking service, but we are giving people what we call as assurance. Okay. Now, what is this thing called assurance? Now, let's come to this. Now, let's look at this simple theory that will explain to us why we need auditing. Let's come to this page number 4. Okay. You see, a lot of things that we learn, it will only be meaningful if you apply them to a big company. You cannot always think about all these small companies and remember because it doesn't work. Okay, you must always imagine, like if you're talking about big listed companies, like maybe you're talking about Maybank, for instance. Okay, Petronas. You must imagine it that way. All right. Now, so only in big listed companies we see the purpose why all these things come in. Especially when we learn towards further, there's a lot of procedures I teach, especially those students that they work in auditing line. If they work in small firm, then they will always say, how come whatever you say, I never see in my life? Well, this because auditing small company and big company is different. We are looking at the big ones. Alright? Now, so let's just imagine that we have a listed company. Take bank. Bank is easier for you to understand because you see them with you. Now, let's say we have a public bank over here. Okay? That's a company. So what happens basically is if you want to own the bank, okay, can you own the bank? Of course, you don't own the whole bank, but you can own a fraction of it. How? You buy the share. Okay. So what you do is you go to the stock market, you buy the share. All right. So collectively, all of us buy a bit of the shares combined, will be everything that we have in public bank. Okay, so the shareholders are the owner. Okay, where you have many shareholder. Okay, you have many shareholder, which can be an individual like you and me, and shareholders can also be institution. That means like funds. For example, EPF. All the money that you have in EPF, right? EPF take your money and save for your retirement. But the question is, EPF got to give you dividend every year. So how does EPF make money? EPF also make investment. That's why EPF can buy shares as well. So EPF can also be the owner of another bank. Is it not? Now, so that doesn't matter about all this. So now the question is, we know that all these are the shareholders of the bank, that they are the owner of the bank, and you have many of them. You have thousands of them. Okay. Now, but you don't expect these thousands of people will actually go and run the business, especially like you may not have the technical skills and so on. So how do you solve the problem? Now, that's why the system or the concept in setting up of company is the shareholders will be owner, but you can appoint directors. These are the agent. They are called agent because they act on your behalf. They are your agent. So we will appoint directors as an agent to take care of the company for you. Now, when the directors take care of the company on your behalf, the best word that we use is what? We use the word govern. That's why you see we always come across the word called corporate governance. Okay? So governing is the best word. So govern means what? So govern is a very rich word that it covers a lot of meaning. It can be like taking care, it can be supervise, it can be control. So govern basically can include controlling, directing, supervising, managing. Okay? So that's called govern. Well, obviously you know, because if you give all the flexibility for people to do things, then they can abuse their power. Now, that's why we do need some regulation. We have to regulate. And obviously, every country, they regulate this way of doing things by passing law. That's why you learn in F8, Contents of your Companies Act. Then you learn about, if you're a director, what must a director do? Yes, you know? Okay, so all these are being regulated under the law. So that's why when the directors are being appointed to govern the company, you must remember that your agent means you're a fiduciary duty. So you have a fiduciary duty. What's a fiduciary duty, remember? What's the three words that we like to use to describe fiduciary duty? It's a duty of 5 of you, each of you try and give me one. Duty of trust, care, loyalty. Right? Now, so the idea of fiduciary is what? Fiduciary is agent. That agent must be loyal to the principal. You cannot betray the principal. So what do you mean by you cannot betray? That means you must do things that only benefit them. Now that is called fiduciary duty. So you have to do things that should maximize interest of the shareholder. Okay. Now there's a lot of things that will happen throughout this process, which is why we see that whatever we learn here in F8 is to prepare you to P1, where we will go in and see the process of corporate governance. Okay? Now I don't want to go through into all that. Alright? Now I just want to plug one of the area out that will be relevant more for us. So the directors are supposed to run the business, take care of it on behalf of the shareholder, and make sure everything is run properly. Okay? But of course, when I pass you a company and I let you run the company, there must be a way that you tell me how things are going on. Yes, you know? So how do you tell me how things are going on? You prepare what do you do? Companies will publish. Now, of course, once a year, you publish this thing called annual report. Okay, that's what it's called, annual report. It's annually. Alright. But of course, we cannot just wait for annual report because annual is too long. I cannot buy a share and wait 1 year to know whether the company is doing well or not doing well. So that's why normally we need regular updates. And minimum, every listed companies are required to publish the results 4 times a year, which is what we call as the quarterly announcement. This is the interim financial statement. So you just imagine that at least you expect there will be a quarterly announcement. Okay? Now these quarterly announcements will be an update to tell the shareholders like every quarter how well you're doing. Okay? Now, so it's only the results of all the quarter. So eventually when all the 4 quarter completes, they will add up all the results. Then they will give 1 full year for you. Okay? Now when they give you the 1 full year, that's where you will expect an annual report will be published. So what's in an annual report? Have you ever seen one before? Wow. This is not only not answering, this is not even responding, you know. Okay. ACCA student are very slow to get heated up. Okay, sorry. Okay. Right. So if you have not seen one, I don't intend to flip through with you, alright, but I've just taken one example. This is an annual report of a company called Audit. Okay? Now it's a very thick report because this is one of the main way that the directors tell the shareholder everything about the business that they should know. Okay? So as you can see in this report, now I just want to show you the content because the content is the fastest way to look at an overview. Okay? Now you can see that this is in the report, but that's what every company must do. Every year tell the shareholder all these things. Okay? Now as you can see all these things over here, what do you have here? You have things like your corporate structure, who are the directors, there's the profile, the chairman will write a statement for you. There we have financial highlights like summary, we have the corporate governance statement, risk management statement, and blah blah blah. You can see here is 26, which is what we call as financial statement. Now of course the bulkiest part of the annual report is financial statement. That's why you see the page is from 26 all the way to 91. Okay, so that is what directors are supposed to do. So from here we understand, okay, that the directors will actually publish an annual report and give it to the shareholder so that you can understand better the business. Okay, and that's why inside the annual report we have the financial statement plus what we call other information. In the context of audit, we only want to see these two. We have a financial statement plus the rest are all called as other information. Sorry, I don't know why this is flickering. You just let me just adjust the wire a bit. Right. Looks like interfering. Okay, right. Now, so when you have this financial statement, I mean, looking at the basic that you learn about preparing accounts, the 3 main components in financial statements will be P&L, earn-out, P&L, cash flow, balance sheet, which explains or communicates to shareholders the performance, the cash position, and also their financial position, the assets, liability that they have. Now, when you start telling all these things to shareholders, of course it's good. Of course it's good. Okay. Now the shareholders will say, okay, now I know what's happening. But now we come back to the concern. The concern that shareholders will be having is, what if you lie to me? I mean, all these are numbers that you prepare and tell me that everything is good, it's nice, but how true is this? How do you verify that? Because, so that's why what the shareholders could be having will be doubts. Okay, what they could be having, their doubts. So when they have doubts, their lack of security, they are not sure what they feel worried, the lack of security. So if you have doubts over something, what do you need is called as assurance. That's the word, you wanted some assurance, okay? So when you have doubts, you will need this thing called assurance. And how do you get assurance? Well, obviously logic is assurance must come from someone who is good with something. And that person tell you what he feels with. For example, you're sick and you think that you have a big problem. Then you go and see a doctor. Then the doctor say, I examine you now, don't worry, you're fine, there's no problem. So you feel better immediately when the doctor tells you something about yourself. Now, so we wanted someone that must understand their accounts very well. Okay? Now, who will this person be? Now, we call this person as an auditor. Alright? So the work that the guy do is audit. So we call him as an auditor. But really, you are not an auditor, but you are a public accountant. Okay? But why public accountant? Because we serve the public, which I will explain on this later. Now, but in order to trust the auditor, you got to come from outside the company. Because if you are coming from inside the company, that you're same gang as the director, then how can I trust you? You could be packed together. That's why we always say that this auditor has to be someone outside the company. And actually what we stress is on the word called independent. That we want the we want the auditor to be independent of the company. And we will see, perhaps not today, but this weekend, what makes an auditor independent. Because you must have a lot of issues that could affect your independence. So we will see that and explore further. Now, so this independent auditor will come and he will carry out an audit. Okay? He will carry out an audit. And that's the reason why people say audit is checking accounts. But it's not true, because checking accounts will only be one part of the work that we are doing. There are a list of things that we have to do in audit. Okay? So the auditor will have to come and do an audit, and at the end of the audit, what the auditor will do is he will issue a report to the shareholder, and the report will carry his opinion. Okay, the report will carry his opinion. Alright? Now, so what does the auditor tell the shareholder? Okay, that's what we want to know. What does the auditor tell the shareholder? So since you say you've not started audit, you've never seen audit before, okay, now come and take a look at this. Okay? Okay. Okay. So this is what we are selling. We're selling a piece of report, okay, and it's not cheap. The normal listed company, the audit fees a year would be around 100,000 to a $250,000. Okay, so it's not cheap. So we're going to sell them this piece of paper for a $250,000. Okay, so now the question is, when you give this to shareholder, what is shareholder looking at? What do we want? Will be a simple paragraph where the auditor will say this. Now that is what we are looking for. One paragraph. That this paragraph carry the phrase. It's a bit hard to see because it's green in color. Let me just enlarge this. Now, we just want the shareholder. We just want the auditor to tell the shareholder. Now the auditor tell the shareholder, in our opinion, the financial statement give true and fair view of the financial position performance, cash flow according to E3, blah blah blah. Okay, but that's it. That's the most important thing that we want the shareholders to know. That in our opinion, financial statement give true and fair view. That's it. You've done your job. You have told them. And when the shareholders see this, shareholders will naturally feel better. Okay, they are okay. Now I think it's safe that their accounts are telling the truth. Okay. Now, so from understanding this, we're able to see. Look at this page now. Page 5. This is what the standard tells us about auditing. Okay, they say that the purpose of an audit is to enhance the degree of confidence of the intended user in the financial statement. That's just like I say, right? You want assurance. That's why audit is to give you more confidence. More confidence means more assurance. Okay. Now, and how? Now, this is achieved by expression of an opinion by the auditor. And what opinion is that? Now, here we say is whether financial statements are prepared materially in respect of the applicable financial reporting framework. Now, that is what we are telling them. Whether the financial statement have been prepared materially according to an applicable financial reporting framework. Okay, now let's start with the easier one. Okay, now applicable means suitable. Okay, applicable means suitable. Applicable is suitable. So what is a framework? A framework is supposed to be a guideline. Framework is what we follow. Okay? So if you say this is the financial reporting framework, it's the framework that we report the accounts. Okay? So what does the accountant use to prepare account? The accounting standard. Now that's why reporting framework will be accounting standards. Okay? Accounting standards as well as the law. But how many accounting standards are there in the world? But how many accounting standards? 九个，你猜 ？Guess how many? 5, 10? How many? Later I got the attendance, then I call your names. Be easier. Alright? Now, answer is many. I also don't know. Yeah, I don't know. I already know. Okay? Now, but you can expect like maybe most of the countries will have their standard. Like maybe Pakistan got a standard, maybe Papua New Guinea got a standard. I don't know. Okay. Now, but the question is, can a company that is based in Malaysia do business in Malaysia, but then suddenly they tell you that they want to apply a Pakistan accounting standard? Now, what sense does it have? Right? The logic is not there. Why is everything in Malaysia, but you tell me the accounting standard is from Pakistan? So this is a problem. Okay, so that's why we only want to use the suitable standard. That it must be something that is applicable to you. Then only it can count. It cannot be any standard. Now, why? Because the quality of the standards are different. So this is the problem with, when this history, when this China have a lot of listed company, they go to the US and they list their company in the US stock exchange. It's exactly like Alibaba, okay? They go to US and list. And when they list, they show marvelous account. And they tell them that everything is good, this and that. Everything wonderful, okay? But then later, they realize that there are a lot of accounting scandals. Well, that's because in China, there are a lot of things they practice are very different. And that give a lot of loopholes. And that's why US has tightened up the listing of this China company and put up more regulations on these people, okay? Because they don't want you to come and mess up and tell us that, wow, you got lots of profit, okay? Now, example, I've studied this Chinese company which is listed in Malaysia. You know how much cash they have in their account? They got 1 billion renminbi of cash. But when I look at their account, they got 1 billion renminbi, but they got no interest income on. You don't feel strange, right? You got so much cash, you gotta put the money where? Must put in the bank one, right? So you put in the bank, even you put current account, what you gonna do with 1 billion cash and don't do interest? Easily you take some money and put with FD, you got interest. But no interest, right? Then this company very funny one, no? Suddenly their share price go up. One day, there's a fire in their factory. All burn. Then the auditor said they cannot do the audit because the record all destroyed, so they cannot verify this is true or not. Well, this is the problem, okay? So it's like, that is the issue we are saying. The accounting standards in different countries are all different. So the quality of the standards can be very different. So that's why we cannot simply let the company choose the standard. They must be taking standards which is relevant to their business. Now, that's the reason why you see example here. This is the financial statement for COVID that the auditors give a report. See, the auditors say what? In our opinion, the financial statement gives true and fair view, blah, blah, blah. At the end, they say what? That is according to international financial reporting standard. That means this company has prepared their account using IFRS, as well as Companies Act. Our Companies Act, our law. Okay? Now, so in that case, this is what we call as framework. So framework is accounting standard and law. Now, but you see the audit report just now, they never say financial statements are prepared in all material respect. Instead, they say in this way. They use the word financial statement presented fairly in all material respect, or they say give true and fair view. Now, this will be the more important thing I need you to understand. But before I go into this, can I just quickly touch on this part? Now, they say that we give an opinion, okay? We give an opinion. Okay? The auditor is giving opinion, right? That's why the audit report starts by saying, in our opinion. The auditor tells the shareholder, in my opinion, this is what I think. But why use the word opinion? Now, what is the significance? Okay? Now, why use the word opinion? What was the logic behind saying that this is only an opinion? Now, you must understand, because we are the practitioner, we got to understand how will this affect us. Okay? Now, the reason why we are using the word opinion is because we don't have to guarantee an opinion. Okay? Opinion cannot guarantee, because opinion is not a fact. Fact, you can say right or wrong. For example, this is a fact that it's a chair, this is a chair, right? It's a fact. If I tell you it's a monkey, then you say I'm crazy. This is a fact. But if I tell you this chair is very comfortable, you agree, huh? You say, how can this be comfortable? But that's how you feel. But I sit at it, I say, I feel very comfortable. That's how I feel. Am I wrong? You may disagree, but I'm not wrong also. But if I tell you 100% is very comfortable, then if you don't agree, then you will come and fight with me. You have dispute with me. So that's why in audit, we only give an opinion because we wanted the shareholders to know we will not guarantee. We will not guarantee. So what's the problem now? This side of account, the auditor check. Now the auditor tell the shareholder the account got no problem. But when the auditor say opinion sahaja, opinion only, what does it mean? That means the auditor say, I don't guarantee you, I say, although I tell you no problem, but I don't guarantee. What does that mean? Maybe I'm wrong also. Maybe I tell you there's no problem, but I actually got problem. Wow, then you are like that. The Chinese said, God also you, ghost also you. You can say anything one. You are both side one like that. That's how. Now, so this is the problem we are having. Now, this is exactly like you are sick. You go to hospital for a surgery. The doctor wanted to cut or operate you. Then of course you're scared because it's surgery. Then you're gonna ask the doctor, hey, doctor, this surgery is safe. Doctor will say what? In my opinion, it's okay one. He give you opinion also. But you also worry, right? Wow, opinion. Then you ask for what? Percentage. You will ask him, hey doctor, how many percent? Now if doctor say, oh, this operation 99% no problem, then you feel better. If suddenly doctor say, this operation quite big one, 50-50, wow, then you scared. See, immediately when you start changing percentage, your confidence starts to change also. Now, same thing for audit. You don't guarantee, never mind. But how many percent can I trust you? If you come and tell me you don't guarantee, later anything happens, I told you, I never guarantee. Well, then you simply do the audit how? Now, so that's why, even though you cannot guarantee, you must give them a certain level of assurance. Okay? You must give them certain level of assurance. Now, come back to this question now. That level is at what level? See, I told you earlier, because this is something concerns the capital market. Capital market means what? It's something like people like public and you and me go and buy share. So we cannot give you this kind of flexibility like anyone can do anything. If you do your way, you do your way, everyone do differently. There's no standard. When there's no standard, everything becomes so messy, right? So once they're messy, how will people have confidence? So it's like confidence will only come when you regulate the market, when you set the rule. So that's why the law says, when auditors do audit, when you give opinion under the law, this level must be reasonable. The law says. So the auditor got no choice. The auditor cannot say, I want to reduce the assurance, cannot. You have to give. The law says this assurance must be at reasonable level. That's the word we use. We will visit this word again, but reasonable is what? It's very confident opinion. You shouldn't feel doubtful. Okay, that's called reasonable. Wait. What is that? Okay, sorry. Now, reasonable means something that you're very confident that you shouldn't feel doubtful. Now, let me explain what is called reasonable later. Okay, but let's just use this thing and go a little bit further. Wait, I think something is wrong with my connector. Kejap ada, kejap tak ada. Let me change one more. Oh, okay, well, problem only changed. Alright. Now, yes. Sit nearer to me, please. Oh, thank you. Alright. So far, she's the only one talk to me. Thank you very much. Alright. Come back. Hey. Let's change this thing. Really cannot work. Sorry, give me a minute. Just plug this out and change this. Okay. Line. Okay, class. Okay, so back to this thing called reasonable level. I want to explain it a bit further for you to catch the concept. Okay. So if you tell people reasonable is very confident, now you might be interested in numbers so that you can see better and understand better actually how high is called reasonable. Now number-wise, I can say is about 95%. But you don't ask me why 95%. That's because usually when we do audit, we set risk at 5% level. So a 5% risk translates to a 95% confident. Okay? But it's only a reference. It's a reference. It is not something like it must be 95 and 94 what. But it's just to tell you 95% you should feel safe. Now that is called reasonable. But the question now is, how do you give the shareholder 95% confident? Because you're supposed to check this account. You see that? So imagine if this is a set of account that the auditor is supposed to go through and check. You must check the account to this point that at the end you must be able to give shareholder 95% confidence. So now the question is, how much do you check? But that is the issue. One, you think logically, if I only need to give you 50% confidence, compare with 95% confidence, you imagine and compare and see the amount of work I'll do is different, right? To give you 95% confidence, I must be checking quite detailedly. But to give you 50%, maybe I simply check. That's the main difference, you know? So that's why this word opinion has an implication. It has an implication on the amount of work that we need to perform in order to support reasonable level of assurance. That's the implication. But I can't tell you how much work. I only can give you a concept that it's a lot of work, okay? But how much, we only see this in the future, where we learn evidence, what is called sufficient, what is called appropriate, what do you evaluate. Now this is one, okay? This is one. Now then the second implication we have to the auditor when we give reasonable assurance is what? Is on the auditor's liability. Now the auditor's liability come in this way. Example, the doctor push a patient to the operation theatre. The doctor cut, the patient died. Okay, patient died. Now when the patient died, obviously the relative get very angry with the doctor and say, hey doctor, how come this patient died? Now what will the doctor say? I told you earlier, right? 99%, no? Correct? 1% risk is still there. That's why he died. So can you say that because of the 1%, just because doctor say like that, now I told you, right? 99% or 1% is up. Does it mean by saying like that, the auditor escapes, right? The doctor escapes liability? No. You can still sue the doctor. Then the doctor must go to the court. The doctor will have to take all the evidence out and tell you that why that 1% is there. Maybe he play back the video, see during the surgery, this is out of my control. Now, the same thing will happen to the auditor. So imagine after I do the audit, I tell you this account true and fact, which basically say no problem. Later after you take the account, don't know how the auditor, the shareholder look at, wow, you tell me no problem. Inside, big problem, there's a scandal, there's a fraud. But you tell me no problem, wow, auditor, you're wrong. You sue me. Please, you can sue me. But when I go to the court, I will just say number one, I told you it is opinion. I never guarantee. Then I will just have to show to the court that I have done everything I'm supposed to do. But I still fail. And why fail? In fact, no, it's luck. It's your luck. Is not? Because this is chance. It's something beyond my control. Now that's why this will have an implication to auditors' liability. But we don't learn liability in F8. But I want you all to understand, okay, that this will have an implication to your liability. So if you are an auditor, you must know how to protect yourself. How does doctor protect themselves? You see, not everyone talk about protecting themselves. Because anything do wrong, people will point finger and say, you're wrong. Then you sue me. That's why you say, doctor do operation, take 2-3 doctors and send there. Why? So that even if I'm wrong, another doctor say that I see wrong. All the doctors say I'm not wrong. Then where am I wrong? So this is what they do, or they take a video, they record the whole thing, so that you cannot say they are wrong. So the same thing happens to auditor. We must do something to protect us. And how do you protect ourselves? Very simple. We must follow what the auditing standard says. Now that become our auditing framework. So there is a framework that tells us what to do in audit. Now what we use in F8 is the framework set by the International Standards on Auditing. Okay, we call it ACCA. So understand, the accountants prepare the account using accounting standard, whereas we do the audit following auditing standard. And but why so Susan must follow these standards? Cannot simply do it? Cannot. If you simply do anything go wrong, you cannot protect yourself in the court. So that's what we're trying to do. Okay, come back to this. So now we say that when you do audit, you're supposed to tell shareholder. Now what do you tell shareholder? you're telling them whether financial statement, now again, before I go on, whether financial statement give true and fair view. So what is financial statement? Now sorry, just a quick one again. Now just now I show you the annual report, right? So I told you that inside annual report, there's so many things there. But where will financial statement be here? This one. Meaning, if you understand what I'm saying, meaning, when I give opinion to shareholder, I only give opinion here. That means I only give you assurance this part. So if let's say suddenly the shareholder say, hey, I read the statement, that one I got problem, auditor, I sue you. Sorry, I don't give opinion about this statement, about this highlight. It's none of my business. Because when I do audit, I tell you F8, I only audit financial statements. The rest are not my problem. Understand? So that's why our scope are more restricted. We only cover this part. The rest we don't care. Follow? Okay? Now back to this. So now you understand what is financial statement. We don't just simply give everything assurance, but just the financial statement. Okay, back to this word. The financial statement, we are supposed to give an opinion whether it gives true and fair view. Now, what do you mean by true and fair view? What is called true and fair? Okay, what's called true and fair? Alright, now let me just go through this part with you. Now, first of all, when we want to know the meaning of true and fair, we are trying to look for a definition. Because if you don't know the meaning true and fair, then how to give opinion? That's why you must know the meaning. So when we look for definition, we realize that this word true and fair, there's no legal definition. Okay? The law that never ever defined the meaning called true and fair. Okay? They never defined. And I'm using this word to be an ideal. I'm saying never defined. It's like, for example, I ask you the definition called handsome man. How do you define handsome man? Got hair or no? How do you define it? Got hair, sorry, don't get it, alright? Now, next week you don't have to come also. Alright? Now, so example, when I say define, right, that's why I say define. Hair must be how many inches, color of the skin is what, okay? And then you must be, for example, how high, your waist must be how big. That's called define, how to define. Because what you see as beautiful, what I see as beautiful is different. That's why you cannot define. Same thing for this thing called true and fair. It's something we cannot define. Reason is because, they give us a reason. They say whatever that you want to see as true or as fair is always changing. Okay? It's always changing. It's a dynamic concept, that's what they say. And something that they always change. How to define? You define it later, they change. So that's why they say doubly define. No way. You cannot define what is called true and what is called fair. Why? Because what is true at one point in time, go to another point in time, it becomes untrue. That's why those days, historical ages, people believe the earth is square and square. That's why they say take the boat until the end you fall down. That's why don't take the boat out. That was what people believe mentality at that time is like that. Now you go and tell the whole world the earth is square. People say it's round, now earth is round. This is why we say things will change according to their expectation. You see how? Now accounts also the same. Let me ask you a question. Alright? So I know your name. Okay? Now come back to this. Okay, so this is what we say, something that's changing. Now, let me ask an example. I don't know whether you studied control before. How to consolidate the account must have control, right? You control a company, then you consolidate the account. Betul tak? How do you control a company? How many percent share you must own? You know, those days we tell people, you can control a company when you own more than 50% share. Betul? You must own more than 50%. But today, is it true? Is it still true that you only control when you own more than 50% share? It's not true already. Because nowadays, people are so smart. What they do is, they don't own more than 50% share, but they can still control it. How to control? Now, that's why the standard say, look at a couple of conditions. Like, can you determine appointment of director? That's why you can own less than 50%, but you can still control. Now, you see, things has changed. That's why what is correct those days and what is correct today is different. Now, that is why they gave us a suggestion. They say, hey, don't look for the meaning called true and fair lah. Why not I just suggest this thing to you? Why not you just comply with the accounting standard and the law? Comply means you follow. Okay? Just follow what the accounting standard say. Follow what the law say. Okay? Follow what the accounting standard say. Follow what the law say. Now, why follow the accounting standard and law? Because these are something that they are also constantly changing. Okay, these are also something that they constantly changing to reflect expectation of the public. That's what they are doing. So instead of looking for the meaning called true and fair, you look at the accounting standard. What the accounting standard says is always true and fair, but at that point in time. That's why you take the accounting standard 20 years ago and you do the account today, sure wrong one, because it's 20 years back. So this is what we call true and fair. Okay? So understanding from accounting standard, we realize that true and fair is what? Now, if you look at the next page, now, true means something is factual. Something is not false. Okay? That's called true. Okay? Fair is what? Fair is you must reflect commercial substance. Fair is you reflect commercial substance. What is reflect commercial substance? Commercial substance is the intention. Okay? Intention. Okay? Intention. The actual purpose. Now, let's example, let's say Shankar is a woman. Okay? She has been staying with me for the past 30 years, and we are not married. But you know what I mean? She has been staying with me for the past 30 years, we are not married. Are we husband and wife? No, we are not. Legally, we are not married. How do we husband and wife? The fact is, we are not husband and wife. Yes, you know? But imagine if anyone asked me if there is anything I do with her, I say, no, we have totally no relationship. But we have been staying together for 30 years. Am I being fair? No. I mean, if you're a girl, if let's say a man stay with you 30 years, never get married, and keep on telling the whole world got no relationship with you, fair enough. Of course, it's not fair. It's how can in substance I stay with you, even though we are not married, I'm your wife also. Agree or not? Agree, right? Now, that is called substance. So if you record an account, you also need both. You need the true and a value. So the best example, I think easier to understand, is leasing. Remember leasing? How many types of lease do you have? 2, okay. Operating and finance. Lease is rental, right? The fact is lease is rental. But is finance lease a rental? No. Finance lease is actually borrow money. Because you enter a lease and you're committed long term, cannot terminate. It's an obligation. That's why when you enter a finance lease, how do you account for it? You recognize the liability. and you tell the shareholder we owe people money, but it's really through a loan or not? No, it's not a loan, it's a lease. That's why in the account we put the disclosure and say, this is a lease. Now that's true, it's a lease. But when I account it as a loan. That's being fair. Okay? Now, so this is what we're trying to tell you about what is called true and fair. Okay? Now, based on what we understand, but because today is just class, I don't intend to do much. If I just not show you now. That's how the exam question is tested. It's a 4 marks requirement. The examiner say, explain me. Which page is that? I think see right now. Let's flip the next page. Page 7. Now the examiner say, explain me the concept called true and fair. I give you 4 marks. So you're going to write something in your answer to give the point. Okay? Now, so how are you going to answer all these? Now, based on what I've explained to you, you write all those things in. Now, I just want to use words like what? No legal definition. Okay? Follow the standard. Follow the law. Alright? Then we want to say what is factual. What is fair. You write all that, you get the answer. Now, I must tell you, being a marker, well, I don't mark all the text paper. Okay? But being a marker, I believe all markers behave the same way. We have very short deadline. Now it's even shorter. You know how fast we must release the result, right? Okay, you see now after 2 weeks, less than 14 days result come out. So that's why our marking period is very short. Right? So to mark paper very short, right? You know markers are trained to look for keyword. We only want to see the neighbor. The word is there. We don't read the answer. We give you marks. We want keyword. So keyword like what? That's why I say keyword like no legal definition. Keyword like what? Follow standard, follow law, what is factual, what is fair. Now all these are the keywords. Now, this is examiner's answer. You write the answer, you only write exactly word for word what she said, hey, how to follow like that. You cannot. You have to use your own word. But using your own word must have meaning. The meaning comes from the keyword. Now example you see, they say that financial statements are produced by the manager which must give true and fair. Okay? Because they only ask you the concept. So she starts by telling you financial statement must be true and fair. Okay? Now the auditor will review the financial statement and then give opinion whether they're true and fair or not. Now then she go into the answer and she say there is no definition. That's the keyword. So I want to see the word no definition. Somewhere in the answer you got the word no definition. Don't know what you write in the front and the back, you get marked. Because marker may not read all your answers. You just see, oh, no definition, no, we have marked. You know? Now, there's no definition of what do you mean by true and fair. So she said, true is factual. So the meaning of true. True is factual. And then after that, blah, 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 I say what? Comply with accounting standard and legislation, the law. Fair is impartial, fair is not biased. Commercial substance. See that? So you just have to write all these things, the 4 marks is in your hand. So that's what you must do. So you understand what is called true and fair. Then you can answer questions like that, but you need keyword. Okay? Now, so I hope you understand a bit. This is what you're expected in the exam. Okay, come back to this again. Now, so, in a nutshell, when you say true and fair, okay, when you say true and fair, you mean comply with accounting standard. Betul? True and fair is you comply with accounting standard. Now I have another question is, when you say comply with accounting standard, comply means follow, right? Okay. Then we have this question. How much to comply, then only call enough? How much do I comply, then only call enough? Is it I must follow 100%, totally no different, then only you call true and fair? So to answer this question, you then need to understand the concept called material. Okay? So you only need to follow materially what the accounting standards say. So that is what you are expected. You follow materially. Okay? Now, so follow materially what the accounting standards say. Meaning, if you follow materially, then you are true and fair. Okay? So, if you don't follow, okay? Now, when standards say something and you don't follow, the result is what? There will be a, what's the word? If you don't follow something, there will be a, start with E. When you don't follow something, there will be a, it's different. Okay, the word is different. Now why I stress on this, because that's the definition. Next time I'll test and see whether you still remember. If you don't follow, there will be a different. There's a different, right? Okay, you don't follow what? There's a different. So the different will be different with what management reported in the financial statement with what they supposed to follow the accounting standard. If you don't follow, if you don't follow, there will be a difference between what the management reported with what they supposed to. There's a difference. Now, this different, we call it as misstatement. The word is called misstatement. Okay, this different is called as misstatement. So if ever someone asks you, hey, you study audit, you tell me what is misstatement, and someone says misstatement is error, wrong. It's not error. Misstatement is the difference between what the management reported with what is supposed to follow in their accounting standard. That is called misstatement. And what caused misstatement, which can be caused by an error. The error is the cause of the misstatement. So please don't say error is misstatement, but actually it's like the same meaning. Just that this is a technical way of how we correctly define it. Now that is called misstatement. Now, but misstatement, as I say, if you follow, you only need to follow materially. That's why we need to measure the problem. How big is that? That's why if this misstatement, if you have a material misstatement in the financial statement, then problem. Then you will not see the auditor give the opinion just now. The auditor will not say, in my opinion, give true and fair. They won't say like that. Why? Since you already have a material misstatement, then you have a big problem. So the auditor will tell the shareholder, sorry, account got problem. Okay? Now, how does the auditor tell shareholder accounts got problem? Now, normally, if you don't have material misstatement, okay, you don't have, auditor will say, in our opinion, financial statement give true and fair view. Normally, this is what we do. That's how we do it most of the time. Because most of the time, account got no problem. That's why most of the time, This is what we say. This is the standard, the normal way of what we say is like that. So now I ask you a question. If accounts got problem, can you still say the same way? Logic, cannot, right? If you cannot say the same way, you have to take what you say here and you modify it. You change it. That's why when there is a problem inside financial statement, auditor will issue a modified opinion. Then people ask, why call modify? Now you understand why modify? Because normally it's like that, but now cannot. Now got problem. So how? Modify the opinion. You modify and change it differently. That's why it's called modify. But when you modify, how do you modify? This one we must learn in the future. Okay? So now we're not going to see. So now the main thing, the main issue we got to see now is what? We got to see actually this word material and not material is what? Because if you cannot differentiate what is material, what is not material, then you cannot give this opinion. So I'm going to explore to you the meaning called material. So can we just come to this page? Page number 6. This is a quick one. Come to page number 6. Okay. Can we just look at the notes first? Now class, it says over here, I put that exam focus, explain the concept of materiality. Okay. Now this question like that is, I think it's tested it's tested. So I say exam focus means it has been tested. Okay, like that. I remember it's about 4 marks or 5 marks also. Okay, so examiner also tested something like that. I give 4 or 5 marks. Now, see, you look at my notes. I say the concept of true and fair is linked with the concept materiality. They are connected. Why? I say for simplicity because the financial statement do not give true and fair view when it is materially misstated. And what do you mean by misstated? Of course, misstated is like mistake, like you say, it's mistake, but we don't define it as mistake. We define it as when there's a difference between what they did and what they're supposed to do. Okay? Now, so material in this case is said in this way. Now, we always write this in the answer. If they ever ask a question, concept of materiality, what do you give the examiner? Now, you're going to tell the examiner, actually, materiality is an expression of relative significance or importance of a matter inside financial statement. Okay? It's to measure whether something is important or not. That's called material. Okay? Now again, how do you know something material or not? They say matter is material if omission, misstatement, would influence economic decision of the user. Anything that will influence decision of the user will be regarded as material. Okay? Now, and why would something influence decision? Why would something influence a decision? Now, we always think that a decision could be affected two ways. One is amount. The other one is nature, which may not be an amount. Which may not be an amount. Like for example, you go and buy dinner later. You don't know what to eat, then you see a stall there sell nasi lemak. You still don't know nice or not nice, but they put there 5 ringgit. Will you stand there and think for 3 hours whether buy or don't buy? Come on, it's 5 ringgit, right? Buy not nice, then never mind, next time don't buy, you know. But will you go there? Let's say, for example, there's an exhibition to sell property. The property all about $500,000 to $1 million. You just go there and see, okay, buy. You won't, right? Because the price is big. Correct or not? Okay. Now, let's say you're a very rich man. This 1-2 million is nothing to you. Don't bother. Okay? So you can afford. So now in front of you, there is a property. The value is 2 or 3 million. The amount is not big. Do you buy also never mind, don't buy also never mind. So the amount is not a concern. So you feel like buying this property. You feel like buying. But I never tell you one thing. Now what I never tell you? I never tell you that beside this property, just right beside, there's this septic tank there. Kolam air, you know. those people that process the shipment. Wow, it's just right beside your property. It's just right beside. I never tell you. Now, if I tell you this information, will you still buy? Now, see, it's not amount, right? But it's something else that affects you. That's why decision to be affected because of amount. Decision can always be affected not because of amount. So that's why we say nature. You know? Now, so we call this type of materiality as quantitative. And qualitative. So the auditor evaluates something material or not based on amount as well as based on nature. That means it may not be an amount. Okay, it may not be an amount. Now, whether it's amount or whether it's nature, you always remember, it's always a matter of professional judgment. The auditor will have to exercise professional judgment. Okay? Okay. So, give you an example. What kind of materiality that we can say is something to do with quality or nature? Now, example, I say disclosure of information. Okay? Disclosure of information. Now, something can only have impact to amount if it affects the P&L or balance sheet or cash flow. Then only the amount is there. Fair enough? Okay? Now, something that we say disclosure means it has nothing to do with amount. Totally no amount. No impact on your profit, no impact on the asset liability. Okay, here is example. Okay? Now, let's say now you're all the investor. You're supposed to buy my share. My company is supposed to buy my share. So you look at my account, you see all the profit, everything, all that. Okay, no problem, all no mistake. Only one information I never put in the account. The information is what? Actually my company is being sued by another person. It's a big case, very, very big case. Okay? Now in this case, I lose, it got a good chance that I got to go bankrupt. It's big. But you know when you have court case, accounting standards say you must look at percentage. Then you decide the treatment. Now because the percentage I assess is about 40 to 50%. It's not even more than 50. You ask me, will I lose or not? I think around 40 to 50% chance I'll lose. So I don't think it's more than 50. So accounting standard wise, they say what? If like that, it's not contingent. Contingent, you only disclose. So I disclose, affect my profit? No. It doesn't affect my profit. It's only an information. I just put a note and say, so and so sue me. That's all. But now, I never show the disclosure. In my account, this thing was not mentioned, zero. So you don't know. So let me ask you a question. Before you buy my share, if suddenly you open the account, I add this information inside and say, someone sue me. And if I lose, I might die. Will you still buy my share? You won't buy anymore. You say, wow, like that, different than it. If you got no people sue, then I buy. But what, now like that, how to buy? I buy then people sue, you die, then I buy for what? So see or not, that information has influenced decision. So if let's say the country said, I don't want to disclose, the auditor can tolerate? Cannot. Auditor cannot, like that material, you know. Why material? Because if you put in that information, then decision becomes different. That is how we assess something as material or not material. Now, in exam, you don't have so complicated stuff, right? Okay? In exam, we normally need to assess materiality because we need to form opinion. And I'll do that again towards the end. Okay? So now I want to quickly discuss some concept with you. Now, to measure materiality in a quantitative way, what we do, right? We always take percentage multiply with the benchmark. Okay? We call that as a benchmark. Now, there are many different benchmarks that we can use, which you see here, like example, I put here profit before tax, total asset, net asset, turnover, you see that? Okay? Now, of course, certain figure is bigger, certain figure is smaller. Now, example, obviously turnover is bigger than profit. Agree? Turnover, sales must be bigger than profit. Okay? Maybe you have 1 million sales, but you only have 200,000 profit. So if you take a bigger figure, then the percentage will become smaller. But if the figure is smaller, then percentage naturally becomes bigger. So that's why you see that we normally take a threshold of like 5 to 10% of profit, or we take like 0.5% of turnover. Now, which benchmark to use, I will discuss in the future. We will do this again in the future, but I just want to get an idea that there are various benchmarks. So commonly used is profit. Okay? This is the most common one that we use to calculate materiality, is profit. And why profit, again, I'll tell you in the future. Okay, so we'll discuss more of this in the future. Now, example, okay. Let's say a company called X Limited. Now, what they did, right, they refused to depreciate their machine. Boleh? Can? Cannot. Because accounting standard says fixed asset must depreciate. Unless it's a non-depreciable asset like freehold land. If machine, definitely you have to depreciate. But they refused. So you know accounting standards say you need to depreciate. There's a difference? Okay. If you depreciate and you don't depreciate, obviously numbers would have been different, right? The NBV is different, the profit is different. Okay, how much is the difference? Okay, let's say now, because they did not depreciate, the net book value was 180,000. And should that they have depreciated, maybe the net book value should only be 160,000. So obviously, as a result of this, you have a difference of 20. This 20 we call as misstatement. That's called misstatement. The different misstatement. But this is a misstatement as a result of different in amount. Okay. So now the auditor will ask, this 20,000 material or not material? Because if the 20,000 is material, then he will modify his opinion. Okay. Now, of course, in real life, we don't straight away modify. We always tell the client, hey, this account cannot do like that. We ask them to adjust. But they may not adjust. They may say, no, we insist, we don't adjust. So if we insist, don't adjust, then fine, then we modify. But if they adjust, they correct the mistake, then there's no issue. So the question is, they correct. Now you see, in small company audit, no such thing. In small company, the auditor do the adjustment directly. It's only the big company audit that the accountants, all qualified people, they fight with you. What right? You say, why must you adjust? I don't agree with you. I see. That's why in that case, you will see all these so-called opposition and resistance. Now, so back to this. Material or not material? So what the auditor do? Calculate. So let's say X has a profit before tax. Let's say PBT of 1 million. An auditor believes that 5% is a reasonable benchmark. So if 5% comes to 50,000, then we will call this as materiality level. Then we will take this and this, we compare. So when we compare, we say, okay, 20,000 is not big, because 50 is the threshold. So if it's only 20, then it's okay. So even management say, I don't care, never mind, you don't get, so never mind. You show the account is 180, so never mind. You just go ahead, you don't mind. Because you're not one, because it's not material. But unless if you got some other misstatement here that add up more than 50, then cannot. Now this is how we assess them. Now that is called True and fair. So this is effectively what the auditor wants to do. That's why in a nutshell, in the future, what you're going to learn is to learn how to search for this. That's your job. How do you detect the 20,000 which we will issue the tax? Okay? Now, back to this. Page 8. Look at page 8. So there are 4 examples there. Okay. As I say, exam, it's quite straight to the point, but I can't show exam question now because all these things will only be able to do towards the end. Okay, but I just give you the straightforward example how we evaluate materiality. Okay, they say example 1, they say pre-tax recorded PBT 200,000. The total misstatement will be 7,000 and 3,000 remain uncorrected. Now, so if you follow what they say, PBT is 200. Now, total misstatement 7, but 3,000 remain uncorrected, meaning the 4,000 you corrected. If you corrected, no problem, because once you corrected, then it's not a mistake. So now we only have a 3,000 that is not corrected. So now you must ask, if you're an auditor, you must ask yourself, can you accept this or not? Now, how do you know if I can accept this? Now, what we normally do is we take the 2,000, we measure materiality. Now, a basic way is like that. We will say, okay, if I take 5% of 200, it should give me 10,000. So, to me, 10,000 is my materiality level. So, 3,000 will obviously be immaterial because it's less than the 10K. Okay? Or another way is people take 3 divided by 200 and say, the percent is only 1.5%, is very small. Okay? Now, so this is not an issue. So if let's say the guy say he don't want to change, no problem. We don't care. Okay? Now, continue. Example 2. Okay, Sunrise has prepared the profit statement which reported a PBT of 100,000. The sales amount was detected to be overstated by 16K. Now, so what about this now? Now, I think this is more obvious. 16K is 16% of PBT, which is higher than the norm. The norm is we say 5 to 10. So 16 is much higher above the 5 to 10 already. So in that case, this 16,000 would be taken to be material. So if they insist, don't want to correct, then you modify. You tell them sorry, then you have to be modified. Okay. Now, so these 2 examples are very straightforward. You don't need to think one. Okay. Now I purposely give example 3 to tell you that when we evaluate materiality, we don't just look at the number per se. You must consider a bit, whether it makes sense or not. Example 1. If let's say I'm a poor man. So I only have 10,000. That's all. Everything I have, 10,000. Now I withdraw all the 10,000 cash out because I need the money for some investment. So I withdraw all the 10,000 I put in my pocket. So I don't know how my 10,000, 8,000 dropped, and it is gone. 8,000 out of my 10,000 is gone. Do you think it's material? Yes, it is right now. Let's say I am an okay man. I got like maybe a few 100,000 in cash. But one particular day, I forgot to bring my wallet. Okay, so my body all got no money. But got one piece 10 ringgit or 5 ringgit, and I got one piece in my pocket. So 10 ringgit with me, Now again, I don't know how my 10 ringgit slipped off from my pocket. So my 10 ringgit, that's all I have with me. Okay? 10 ringgit is my everything. But I got 300,000 in the bank. So 10 ringgit book drop. So 100% of the money I had on that day is gone. Is it material? 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 Of course no lah. Because I have few 100,000 in the bank, it's 10 ringgit, throw also never mind. Because that doesn't reflect what I normally have. Because what I have is much higher. Okay? So that is a concept which I want you to see this example 3. Now it says that Neptune has, according to its draft account, show they have a PBT with just $100 that year. Only $100, very little. Only $100. Why? Because that year is abnormal. It's disappointing. That means that year is not a normal year. Result was bad. Okay, so it was an abnormal year. So it's a disappointing period. And when you do the audit, suddenly you realize there was an addition error which overstates the sundry expenses by $10. Now I'm asking you, if you take $100, the profit that they report for that year, the $10 is it 10% again? But will you say it's material or not material? Then I ask you, does the $10 reflect what they normally have? No. It's only because that year they are making losses. That's why this $10, if you compare with 100, it's 10%. But that's not what they normally have, because normally they make much higher profit. So that's why if not, then I ask you, if it's a loss, then how you count it? If loss means the figure is negative, then 1 cent also so 100% of it. So that's why in that case, this is what we are saying. The $10 will not be material. You cannot take the 10 and compare with 100. Okay? You cannot use 10 over 100 and say it's 10% of PBT. Cannot. Because the 100 doesn't reflect what they normally have. So what's your solution? Now, in this case, usually we can tell them, you can consider using your average profit. One solution, use average profit. Now, or another way is, you don't take profit, you can switch to turnover. That means you use your sales as a benchmark to calculate materiality level. Okay, now, so this is what I'm trying to tell you, how things could have been different in this manner. Now the last one, this one is even more difficult to see. Okay, it's just for discussion. Alright, example is I don't do so relevant. Now, Satan has produced financial statements with a PBT of 300,000. So I give you the trend from 2007 to 2011. So all the 5 years reported PBT was 25, 26, 27, 28, 29. This year how much? 300. That's what they reported. You see figure, I think the figure is all obvious, right? It's steadily increasing. Quarter after quarter, you're steadily increasing. Okay? Now, the audit test indicated that certain finished goods stock valued by the company at cost, have NRV which approximately 14,000 below cost. What's the accounting standard on stock valuation? You must value stock at what? What's the word? Stock must be valued at the lower, correct or not? You value stock inventory at the lower of cost and NRV. That's what the standard tells us about stock valuation. Now they say NRV is below cost, okay? NRV below cost. But they value at cost. standard say must value at the lower. The lower is NRV, but the company value at cost. That is wrong. Now, in that case, you would overvalue your stock by 14K. So you overvalue the profit by 14K. So this will be a misstatement of 14,000. And we would like to ask, is this misstatement material or not? If you calculate how many percent is this? 14 out of 300. How many percent? 14 out of 300 is about 4.67%. Okay? 14 out of 300 is about 4.67%. And normally to us, something material is between 5 to 10. So amount-wise, is this big? It's not. It's close, but it's not big. Because it's not even more than the 5%. Now, then you say, not material, right? Is it really true it's not material? So that's what we're going to see. Whether to evaluate something material or not, we cannot just look at the number. We must look at the whole situation and analyze the impact. Now, what's so special about this example is you see, I purposely give you all the 5 years to show a trend. The trend is every year your performance is steadily increasing. You notice that? Now, if you show this trend, the trend is like that one. Will you buy a company that the profit every year, quarter after quarter, is going up? Yes, you sure buy it. If you can find a company that quarter after quarter the profit is going up, you must buy the share. Must. Because the share price sure go up. Very good in share investment. Yeah, I tell you, must trust me. The share price must go up. So why? Because you're showing a growth. But if suddenly you take this amount, 14,000, you take 300, you corrected the 14, it becomes 286. My goodness, 286 means 290 dropped to 286 is a downtrend already. Now you see, as long as it's not a downtrend, I don't care. 290 go to 292, it's still up, right? Even 2 also is up. But if you suddenly drop a little bit, it's a drop, it's a change in trend. Will you as an investor think twice now whether or not to buy the share? Compared with the first example, you see the impact or not? Yes or not? Now, if you cannot see this impact, I normally give this simple example which you understand why I say small thing can still be material. Now, I like to ask students, if I mark your answer in the exam, I give you 1 mark lesser. Because I mark the text, the figure, I overlook a figure. Suppose you have 1 extra mark, I give you 1 mark lesser. Material, huh? Material. Now, it depends. Because if you score 64, I give you 1 mark lesser. Doesn't matter, right? So what with the 1 mark? But if you score 49, then 1 mark is equal. See the difference? At 49, this 1 mark is so important. At 64, this 1 mark is useless. So that is what I'm trying to tell you. That this 14,000 technically is not big. But in this case, it's different. Because in this case, it will cause this, a change in the trend. Alright? Now, so in that case, I will put a conclusion that the 14K is material because it would cause a reversal to your performance trend. So I would say this is a qualitative materiality. Okay? It would be material because it would cause reversal to performance trend. So it's a qualitative materiality. Okay? Okay, so far? Now, this is the first part that I want to do with you, to explain you what do you mean by audit. So I've covered all the keywords like what's called opinion, what is called true and fair, okay, what is called material. Now these are all things that they have tested in the exam, okay. So I also put in a sample of the question there with the answers by the examiner, which I highlighted to you. You must know the keyword, okay. Now that's one part. So just nice, we take a short break. We come back, then we move on to look at assurance. What are different types of assurance engagement? Okay. Right, so your friend worked in an audit firm, okay, which is what we usually like to call an audit firm. Now really, we are not an audit firm, but it's a public accounting firm, okay? I mean, technically speaking, audit firm is public accounting firm. Now, why call public accounting? Because an auditor is a public accountant. But why call public accountant? Any particular reason? Why we say we are an accountant for public? Now, because being a public accountant, which actually you learn this if you go to P1 next time, okay, that we have a service as a professional accountant that we serve to protect interests of the public. Now, the interests of the public, how do you protect? For example, when we do audit, we know that we are here to protect interests of the investor, because if we don't do audit properly, then shareholders that depend on us will suffer. That's why we have a general duty that protect the general public in that way. Okay, that's why we call ourselves a public accounting firm. Now, so the firm are actually offering a various type of services, which we divide them into two categories. Now, one is called assurance based and non-assurance based. Okay. So there are services that they are assurance based, there are services that they are not. Now we know from the start, just now I've told you about audit. Audit is a form of assurance engagement, because I've told you earlier through agency theory. Shareholders needed assurance, and assurance is what? Confident. You want to feel better, okay? So that's why when we say an assurance based engagement, what really is assurance based is something that you will enhance confidence. You make people become better, they feel more confident with something. But is that how the standard tells us about assurance engagement? No. Now, the ISA say, if you want to call something assurance engagement, you need 5 elements. Any engagement that you have all the 5 elements, you call them assurance. When they don't have the 5 elements, then they are not assurance engagement. Now, and this has been tested before. 5 marks, asking the student to write down the 5 elements. So which 5? Now all these things I need you all to remember that, as I said, the keywords are the most important. So on and off, I will give you mnemonics, so it's easier for us to remember. Okay. The mnemonics to tell us what are the 5 elements are called certs, and actually it's quite easy because assurance is we are there to certify the account, right? Certs, so it's easy to remember. Okay, so certs will be the 5 elements. Now, before I go into the 5 elements, let me just list down the services we do. Now, audit is one. You know it, audit. So I write down here example when we do financial statement audit. And remember earlier I told you, if you do audit under the law, what level of assurance must you give? What do you call that? Reasonable level, okay? Audit will give a reasonable level of assurance. Now, you know, we have another form of assurance engagement, that the work is quite similar, but not exactly the same. Quite similar, the nature is quite similar with audit, but we call that as review. Financial statement review. They are also like audit in the sense like they also check account. Okay, and after checking the account, the auditor will also give a report about the account. But the report is different. Okay, so this is different in the sense that the level of assurance is different. It's called moderate level. Okay, it's called moderate level. Now I will explain a little bit later. Now, these two types of service, they fall in the same category because they are doing about the same thing. They are about checking account. Okay? Now, and as one more assurance engagement is completely different with these two, which is an examination of prospective financial information. Now, let me explain what is all these things later. Just so you understand. Okay. Now, these fall as assurance. Okay. Then there are two more non-assurance, which I call them as agreed upon procedure and compilation of financial information. Okay, agreed upon procedure and compilation of financial information. Okay, so I will have to start with assurance. Now let me just tell you a bit about the 5 elements. What are the 5 elements? Now, why we need to know the 5 elements? Now, actually, as far as exam is concerned, the 5 elements is just for you to write the theory. You need just write down the 5, you get 5 marks. Okay. Now, but I will show you the 5. Then I'll tell you what's the difference between audit and review. And this is also one thing they like to ask, the difference between the two. Okay. Now, to show you the 5 elements, if you don't mind, can I just come back to page 9? Okay. Okay. Now you see this paragraph. The auditing standard tells us about assurance engagement. Now in this paragraph, there are 4 things I can show you exactly from here. So the 5th element I will add it on later. Now let me just use different color to show you. Okay. Every color is an element. Okay. Now it says that assurance engagement is for the professional accountant to evaluate or measure a subject matter that is responsibility of another party. It's the same color because it's the same element. Okay, against an identified criteria and to express a conclusion that provides the user with a level of assurance regarding the subject. So I highlighted 4 different colors. So there are 4 elements here. Okay. The first element is a bit unique because got 3 things there. Now we call this as 3-party relationship. Okay, we call this 3-party relationship. Okay, so the assurance engagement must have 3-party relationship. Okay, there must be a subject. Subject is thing, something. Okay, Now this is something that you are evaluating, but you know when you evaluate, you need something to tell you whether it's right or wrong. So that is called criteria. And of course, at the end of evaluation, you have to issue a report, which is called conclusion. Now, so this is the 4 element. Now I say got 5. What's the 5? Now the last element is actually embedded. This is the last element called engagement process. So 1, 2, 3, 4, 5. Okay, and we use this to call it as certs. Okay, so let me just explain a little bit to you what is this. Then I'll come back again. Now, if you don't mind, just turn to the next page because there's a blank there. Now, I would like to use audit and illustrate you the example. Because if you say assurance engagement, you are able to show all the 5 elements. Then audit is assurance. Then you definitely can show me the 5 elements. So if you are asked examiner asks you, explain me the 5 elements of assurance, then what I'll do in my answer is I'll talk about all that. You know, when you talk about something, the better way of explaining the meaning is giving an example. So that's why when you write something, after that you say, okay, for example, in audit, what is this? What is this? So that will make your answer much better. Okay? Now, 3-party relationship. The 3-party that we're saying will be the accountant. You can also call practitioner. Okay? The responsible party and the user. Now, you know in audit, the practitioner is called auditor. There is an auditor. Now, the one that is responsible for the account. Who? The directors. Because they are the one that sign their account. And users would be shareholder, exactly. Now, so I already proven that 3-party relationship exists. Okay, there's a subject. Subject is something that you're checking. What is that? The financial statement. That's the subject. You know, when you evaluate this financial statement, you need criteria. The criteria is what you use to tell whether this financial statement gives true and fair view. And remember earlier I tell you what is true and fair. True and fair is what? Comply with accounting standard. So accounting standard is the criteria. You use the standard to tell whether you comply or not. So the criteria will actually be your reporting framework. Criteria means your reporting framework. So effectively, criteria will be your accounting standard and law. Okay. Now I skip to the last one first. Now then at the end, we have a conclusion. Now conclusion has to be a written assurance report. It has to be a written assurance report. So what's the written assurance report? What's the report that we're giving? Now the report we're giving is called the auditor's report. The auditor's report. See, I can show you all the elements, how it existed in audit. Okay? Now, when I say the last element is called engagement process. So what's an engagement process actually? Now, an engagement process describes the methodology defined approach, okay, that we use to collect evidence to form conclusion. It's a process that we use, this is an engagement process. So it's the use of a methodology, which we call a defined approach, that we use them to collect what we need to form conclusion. Now, why we say it's a defined approach? Because you cannot simply do it. Alright, why cannot simply do? Because we have to have a framework that tells you how to do it. So this will serve as our right here, our auditing framework that tells us how you have to do the audit. Now, in this case, it will be the ISA. You know, every engagement, every assurance engagement auditing standard, we have international standards on auditing. We also have international standards on review engagement. We also have international standards on assurance engagement. We have ISRE, ISAE, ISA. So everything has a standard. That the standard says, now you must do like that. You must follow what we say. Now that's the engagement process. So you cannot change side. Okay. Now this will be the 5 elements. So I have write down some of these things here. Now these are the elaboration. So if examiner asks, list and explain 5 elements of assurance, you just write this. You explain on. You can use the word here in the notes as a reference. Then you use audit and give example. Then you sure get 5 marks. Okay. Now, so that's what you can do here. Follow? Okay. So I mentioned to you certs. Okay. So actually cert stands for what? What's the C? What do you think? CERTS. What's the CERTS? You cannot remember, then no use. You go and say, cert, but you don't know what cert. Cert will be what? C for? C is not conclusion. Okay? The C is your criteria. Let me just write here. C is criteria. E would be your engagement process. R is report, which is your conclusion. Report. T is the 3-party relationship, and S is the subject. So that's what certs mean. Okay. Right, we go back to the front, okay? Okay, now I go on to this concept now. Now, if you go back and read this, the standard says, it says that the assurance engagement intended to enhance credibility of information. Okay, it's to make something more credible. Credible means trustworthy, boleh dipercayai. Okay, and they say the level of assurance provided conveys the degree of confidence. Okay, the level of assurance provided convey the degree of confidence. Now, how many levels do we have? We have 2 levels, which I have said earlier to you. One is called reasonable, one is called repeated. Okay? One is called reasonable, one is called limited. Now, little bit, objective, like if you read the standard now, you still don't quite get the idea. Because they say objective or reasonable is a reduction in insurance engagement risk to an acceptably low level if the circumstances of the engagement as a basis of positive form of expression. You read this a lot, I don't know what, I don't have it after, because we still haven't covered what is called risk, so don't talk about what risk to acceptably low level. Now, the main word I would like to introduce is the word called positive. So we see that reasonable is a positive form of expression of conclusion. Okay, it's a positive form of expression of conclusion. Right. Limited is a negative form of expression of conclusion. Okay, now, so then you will say, okay, fine, I get the idea. Reasonable is positive, limited is negative, fine. So positive means what? So exactly what does it mean? You must give me the meaning. What does it mean? Now, we know the highest form of assurance, is guarantee, 100%, correct? Guarantee. But you know, I told you earlier that we cannot guarantee opinion. That's why we only say reasonable is high but not absolute. Not I say one, standard say one. Okay? High but not absolute. Now, that means reasonable is a confident opinion, but they are not always favorable. Sometimes you see people write like that, okay? It's a confident opinion, but they are not always favorable. Okay. Confident, you feel very confident. But what do you mean by not always favorable? That means not always correct. Guarantee is always correct. But sorry, cannot be always correct because there is a chance I could be wrong. Now that is called reasonable. So reasonable is called positive. It's called high but not absolute. Okay? Now what is limited? Now limited is a negative form of expression of conclusion. So basically they say this is giving you a risk. Now if you read this line, that's what they say. This is giving you a risk that is greater than reasonable. Meaning, when we do limited assurance, the risk that we have is higher than reasonable. The opposite of risk is confident. Correct? Risk and confidence is the highest. 95% confident is 5% risk. So if you say the risk is higher, that means confidence is lower. Logic, correct? So if I tell you this one got 20% risk, meaning 80% confident. So that means a different way of telling what is reasonable, what is limited, is you have a level of assurance that is lower than reasonable level. You might find it like so strange when you see like that, but that's exactly how the sentence says. I show you the way. Is a risk greater than reasonable? But I don't use the word risk. I use assurance. A confident lower than reasonable. That's called limited. Okay. So now you know there are two levels of assurance. Okay. So I want to compare this because so far we understand what is called audit. Okay. I want to compare this. Now, you go for a financial statement audit. Okay. It's not the right way of saying But you just imagine, okay? I just want you to give you a concept. So if it's just a concept, maybe you don't write better. You see, you understand enough already, so that you don't read the wrong thing, okay? Now, let's say the auditor will check the financial statement, okay? The word is not check, okay? But the auditor will check financial statement, look for mistake. So check. He find everything in order. Then he will give an audit report. This report carries an opinion, which we call audit opinion. And supposedly this opinion must give shareholder confidence. You must feel very confident. That's why it's high assurance. Okay? Now, still remember the word I show you with an example this time. I show you how does the auditor give his opinion, how he say his word. How do you start? 常客. In our opinion. That's how the auditor starts. The paragraph is in our opinion, financial statement give true and value. Okay? Now you see, this is how the auditor say. The auditor say, in our opinion, financial statement give true and value of ... Now the rest not important. The starting line is very important. That's what shareholder is looking, which I show you, right? The report exactly that's the word. You want to see that. Now, you know when you say like that, right? This word is supposed to give the shareholder confidence. Okay? Now, you can also be doing a financial statement review. A substitute is a different type of service, but actually more or less like audit. Review also need to check financial statement. Okay? So once you finish off the review, you also give a report. But we call this as a review report. In the review report, now, because you are not giving opinion, and we don't want you to get confused with opinion, that's why the standard says cannot use the word opinion. So what is that? Now, we call this as a statement of negative conclusion. You're giving a statement of negative conclusion. It's a conclusion that is negative one. So you say, what's the difference? The difference is, when you read a review report, naturally you don't feel so confident that you read audit. That is the difference. You don't feel so confident. So how to tell something that you don't feel so confident? So the English words are very important. So important that the moment you read this word, oh, now there's a difference. Now how to put them in words? A review report will normally be written in this way. Nothing has come to our attention that causes us to believe why financial statement do not give true and valid. You can copy this one as a reference. This is something you need to know. The arrow is working. You understand that? Alright? Now, you can take down the blue words. Maybe I'll explain this to you. Now, as you see, oops, the auditor cannot be there in person to tell the shareholder. You cannot say, if you know, this one confident, this one not so confident. You cannot do that. That's why the words itself must do the work. You see the words, you naturally know the difference. See, like for example, let's say Shankar come and ask you, Mr. Mao, you think this time F8 exam I can pass? I tell you, in my opinion, you can pass. Okay? 1 week. Or I say, I don't see why you should fail. What do you know? Of course. If I say, in my opinion, you can pass, why immediately you feel so happy. Mr. Lau also agree I can pass. But the second way is, I don't agree you can pass. I just say, I don't think why you should fail. But I never say you can pass. So I am also doubtful to myself. So I can pass. That's why we say, I don't see anything that caused me to believe why the financial statement give or do not give true and fair. But I never say it give true and fair. I never agree also, but I also never disagree. But this one, I agree. Now that's the difference. So in this case, shareholder will feel very confident. This one, moderate confident. That's why it's reasonable and moderate. Now, we will then ask the question, how come like that one? Okay, how come like that? How come audit and review will be so different? Now, this is the reason. It's the checking process. The checking process we do in audit and we do in review is so different that the result become opinion is different. Why? We do a lot of work in audit, very detailed. So this process audit is very thorough. Okay? Audit is very thorough. Very detailed. Now, reviewer, you do a lot lesser than audit. A lot lesser. But I use the word I said you don't understand, so I don't write it. Because when we do review, we only do inquiry and this thing called analytical procedure. You know what is that? So don't get the spice. So I know it's a lot lesser. Now, give an example. If I do audit, right, I open the account. The customer tell me my bank got 5 million cash. The auditor will say, I don't trust you. Let me call the bank. So we go and ask the bank, hey, give me a bank if I confirm the guy got 5 million cash. Then the bank give me a letter and reply me 5 million expensive. I do like that. That's why I'm very confident. But when I do review, I won't do that. I think show me the bank statement. I say, okay. The bank statement can be fake. But the bank directly tell me it's hard to fake it. So that's why this work here much lesser. This work here very detailed. That's why here very confident. There not so confident. Then you say, then why we need to have these two different? Do audit lah. Then why must we have review? No, because circumstances could be very different. Now one example I can tell you in Malaysia is like that. I told you just now. Listed company do quarterly announcement. Under the law, you only need to audit financial statement. The law say that. Quarterly result, they are all unaudited. Don't need to audit. If everything audit, too costly. That's why you cannot be like that. You must give and take. We only say once a year audit. This one don't need to audit. But you know some companies say, yes, I don't need to audit. But I can do something to show my shareholder that we are good. So we give you even more confidence. So that the share price is even stronger. We want to do that. What can we do? If I do audit, costly law. So is there an in-between? Review. That's why some company, they choose to review their quarterly result. then they give a review report. So when the shareholder look at it, oh, a review report. Now you will still feel better, especially when every other company don't do, you do. Is that better? That's better, you know. So this is why we do a review. Now not only that, some country, like for example, you look at UK. UK is a country that they practice small company audit exemption. Meaning, certain company of different size, because they are called small company, they don't need to audit. Not like Malaysia, dormant also must audit. So there, up to certain size, don't need to audit. Now, if certain size don't need to audit, your account won't be audited. But again, you might want to have some assurance on the account. Maybe example, you want to borrow money. You want to send your account to the bank. But the bank says, this account you do, very hard for us to trust you. So the guy said, don't worry, I do something. But do audit, I said, costly one. So in between is what? Review. And then they do a review to enhance it a bit. So you can have a benefit of both worlds. Lower cost plus little bit of assurance. Okay? Now that is where review comes in. Okay? Now class, because we have not started audit. Today is introduction. Audit, all these things we take 2-3 months to study one. So I need to finish everything in audit. Then only I can compare and tell you what is review. So this thing today just introduce me. Towards the end, the last class, I will tell you again the difference between the two. Okay? Now, so that is the two things. Review and audit. Okay, now I want to discuss this with you. Page 11. Okay. Now this one, my notes very detailed because I take it from the standard, but I won't go through everything with you. Okay. We know that audit is reasonable, review is moderate. We know that, okay? Logic. Why review has less assurance than audit? Because the work in review is less than audit. That's why assurance also less. That one you understand, no? Okay? So that's the reason why we know review is moderate. Okay. Now what I want to see is the other thing. When we say audit is reasonable, then we would like to ask a question. Is it possible that this become absolute? That means, can the auditor guarantee or not? That's what we're asking. Can you guarantee or not? Because if you can guarantee, then maybe the review can increase the assurance. So you can ask the auditor, can you guarantee your opinion? Now obviously auditor say cannot, no way. Just like you come and ask me, hey Mr. Lau, guarantee I pass F8 cannot. Without telling me you can. Okay? Now, so you ask the auditor to guarantee. Auditor say no, impossible. And obviously you want to know why. Because we have inherent limitations in audit. Okay? We have inherent limitations. Natural weaknesses are inherent limitations. Inherently, it's like that. Just like Asian, inherently it's small size. I don't know, you look at our Asian, our leg also short one. That's why all those who run very fast is not Asian. It's the blacks that have long legs. You know, that's not inherent, naturally that. Okay, sorry, my notes are very long. A lot of words. Okay? Now you don't expect that if I ask you 5 months, you write all these things. So I just want to cut it short and make it much more simpler. So I don't have a space here. Because here tak cukup lah. Okay, I got no space here. So I write somewhere lah. Okay, let me just write here. Now I would like to discuss with you inherent limitation of audit, which explain you the reason why we can't guarantee our opinion. Okay? Now, a lot of evidence, audit evidence, they are persuasive, they are not conclusive in nature. Okay, a lot of evidence are persuasive and they are not conclusive in nature. Now, there are a lot of things we do in accounts. There is no 100% guaranteed exact way. Okay, they are very persuasive. They are not conclusive. So end of the day, you cannot say something is definitely right or wrong. Now I use that the same example like court case. Okay. Example, there's a litigation. Someone sue your client. Okay, someone sue your client. And I told you, right, the judgment is based on the outcome. You must assess what's the percent that you're going to lose the case. So if the management tell you 50-50, but 150-50, then they give you their reason. They tell you, oh, because it's like that, because this is what they did, this is what we have, and then after you say, I agree. Alright? Now, see, I persuaded you to accept what I do. But I cannot guarantee this is the way, because end of the day, we don't know what is it. Now, that's what I say. Something is persuasive, not conclusive. Okay? How to guarantee something like that, right? Now, number 2, there are many items in the financial statement. They are related to future. So they are very uncertain. Okay? They can also be very subjective. So these first 2 points are connected, not unrelated. They relate to future. And why we cannot guarantee? Because how to guarantee future? We don't know what's going to happen. Right? So that's the problem. We cannot guarantee something that not yet happened because we don't know what's going to happen. There's no way to guarantee. Okay? Now, number 3. Audit uses sampling. That's how you do audit, right? I mean, you don't expect the auditor to check 100% everything in the account. So what we do is we take some here, some there, and then we check if the sample got no problem. Then we will assume the rest should be okay. That's how we do the audit, is sampling. So you take the sample, you check no problem. How sure are you the one you don't take or no problem? You don't know also, that's the problem. So that's why we cannot guarantee. So you're not sure the rest, you don't check if there's a problem or not. So sampling, okay? Inherent limitation to entities, accounting, and internal control system exists. Okay? Inherent limitation to entities, accounting, and internal control system exists. Now, this one, you look like that, actually you don't understand the meaning. The rest you read, you still can understand, but what do you mean by inherent limitation and control? So I just try to give an example for you to understand. In the exam, you just write, okay? Now, See, earlier I told you, let's say your mother asked me, hey, Lau, you guarantee my daughter pass F8 can or not? So I tell your mother, auntie, before I guarantee your daughter, I must ask your daughter to guarantee something. If your daughter can guarantee, I guarantee you. If your daughter say cannot, then I cannot. Now, so I ask you back. So your mother wants me to guarantee you should pass F8. Let me ask you a question. Can you guarantee everything I teach 100% cannot forget? You guarantee this? There. Human, how can I? You cannot, right? You cannot. Then I tell your mother, sorry, you cannot. Because your daughter, the exam, not me. So if everything I teach your daughter cannot guarantee, cannot forget, then how to guarantee she can pass? So this is the issue we say here. See, the financial statements are prepared by the management. So when management prepare financial statement, they go through accounting system. So the management will use this to produce the financial statement. Now, then the auditor will come and check. The shareholder asks the auditor, can you guarantee me your opinion? Then the auditor says, sorry, before I guarantee, I want to ask your management a question. You will ask management, hey management, can you guarantee when you prepare your account, don't make mistake? If you guarantee you don't make mistake, then I will guarantee your shareholder my opinion. Then management says, cannot. Human, how long to make mistake? That's why management say cannot. The management cannot guarantee because management say our system also have inherent limitation. That's why we cannot guarantee. Now, what are the limitations? Now, we will see this in the future. Like human error, okay? Like for example, you have a poor judgment, cost, benefit. There are a lot of things that we'll see this in the future, okay? Now, so these are the inherent limitations. I think enough already, enough for you in the exam. Now, but I did put in a sample here, page 12. Page 12. Now, I also extracted a sample of what examiner asked previously. See, there's a 3 marks question. Describe 3 limitations of external audit. Now, I gave you 4 points. You write any of the 3. But of course, you cannot just write audit user sampling and expect to get 1 mark. You must write and explain, elaborate your answer. Okay? So I gave you the examiner's answer, which you can read and use as a reference. Okay? Now you see, examiner gave quite a number of choices here. Example, examiner says sampling. You say how she explained the answer? She says sampling. It is not practical for auditor to test 100%. So, they apply sampling. Therefore, there could be an error in the item that is not selected for testing. That's all right. It's the same thing I tell you. Put them in words. So, I normally tell students you have 2 choices. 1, you understand something, you go exam, you write your understanding. But if you cannot understand, then you got no choice. If you cannot understand, you do the hard work. Hard work is what? Memorize. Study, read this 10 times, and then if they ask, you write down. So if you can understand, it's easiest, because understanding don't need to memorize it. Okay? Now, so all that is what you see here. So they use sampling, subjectivity, see inherent limitations of internal control, then persuasive. That you can take this. Okay? So 3 only, ma. I give you 4. Correct now? I give you 4. Now exam, you want to pass only. Pass 2 enough already. Because passing mark is 50. I don't need to write all the 3. So be practical. I don't need to remember everything to pass. I just remember 2 is good enough to cherry mark. Okay? Now, so that is the first part. Okay, so I finished this. So I've told you what is reasonable, what is moderate, and why audit cannot guarantee. I explained all that to you. Okay, so let me just finish this small bit, then I'll go on to the other one. Look at page 12. Page 12. Okay, what is the meaning of examination of prospective financial information? Now class, you see, prospective is potential like that. Prospective is like potential. So prospective financial information is something that you prepare that relate to the future. Financial statement relate to the past. This is something that relate to the future. Okay? Okay. Obviously, when you prepare something that relate to the future, you will need assumption. Example, I want to go bank and borrow money. Bank will ask, can you pay back? So I said, can. Now, this is what I expect to have in my cash flow. So I tell the bank, okay, I will have 500 students. One student pay 1,000 ringgit. I have 500,000. So I do all that. What is that assumption? I have assumption of how many students, assumption of how much is the fee. So I'm going to use assumption. Now, but when you prepare this prospective financial information, we normally classify them into two. Here. One is called forecast. One is called projection. Just the next page. One is called forecast. One is called projection. So you will ask, what's the difference? Okay, the difference lies with the assumption that you're using. Forecast refers to prospective information that we prepare using assumption that events, future event that management expect to take place. That means you believe it will happen. Okay, you believe that this is going to happen. Now, for example, I can tell you, even though I don't know what's the future going to be, but I can tell you, for next year, July, the college will still have ACCA course, and because we have ACCA course, we will have intake, we will definitely have students, we will definitely have fees. Now, how likely that this is going to happen, I think it's very likely. But of course, anything can happen. But this is something I expect to do. But I can also say that maybe in the future, I will run extra 5 programs. Maybe I will do one program on probably physiotherapy. I'll do a program on, let's say, on human science. I'll do a program on literature. So I'm going to start different programs. But how sure are you're going to do? I don't know. Maybe, maybe not. Now, when you have something that you're still not sure you're going to do, we call that hypothetical. Now, that's why projection will be prospective information that is prepared using hypothetical assumption. And we call hypothetical means something that they are not necessarily expected to take place. That's the difference. So how we apply this in practice? Now, normally this is what we do. Maybe, let's say I want to prepare a cash flow forecast. Now, forecast must be something you expect to take place. Then only something near future you know what's going to happen. So I will prepare the cash flow forecast for 2016 and 17, 2 years. Because I can see what I'm going to do in this coming 2 years. Then I will prepare a cash flow projection for the next 2 years, 2018 and 19. So there's a difference, when you call projection and cash flow. So once you call projection, you can use any assumption. Like I can run 5 courses. Then whether you will do or not also it doesn't matter because it may not happen. Okay. Now that's how the difference comes in. So one is called forecast, one is called projection. Okay. Now, when you do all this, the bank will say, all these figures you bantai yourself. Obviously, you want to take a loan, you should put, you got a lot of students, you get a lot of money, then you just want to show me you can pay the money. The bank also don't trust you. So how can I enhance this credibility? Now, I can have the auditor to come and, we cannot use the audit because it's not the past, it's the future. That's why we use the word examine. So the word is called examine. We will ask the auditor to come and examine this thing. And once they examine, they will give what? They will give a report, assurance report. But when you give assurance report, the report is on what? Now the report is, we will give a negative assurance assumption used are not unreasonable. Now you see, I put the way I write also is negative, you know. I say the assumption used are not unreasonable. I never say assumption are reasonable. I say they are not unreasonable, but I never say they are reasonable. Okay? Now this is called negative. So we just want to have a report on the assumption. That's all. Now, but we won't go through how to do it. Really, it's not in the syllabus. But it's just to let you know that there's something we do called examination of prospective information. That's the service. Okay, now let me just finish this off with the next one. You look at page 14. Now, this one don't need to write much. I'll just tell you what is that. Okay. So for the non-assurance engagement, there are two types of services. You see, one is called agreed upon procedure, and one is called compilation work. See that? Page 14. Agreed upon, compilation work. Okay. What is agreed upon and what's compilation work? Now, so far in exam, this is also not important. So I just want to touch and then just go. Okay. Now, agreed upon is for auditor to carry out procedure of audit nature. When we say audit nature, means investigative nature. Involve checking. Okay? And at the end of this procedure, we will report factual finding. Now, that's the word I want you to see. We report factual finding. So, no assurance conclusion is involved. It's called agreed upon. Now again, a simple example to appreciate this. You go to a lab and you say, I want to do a blood test. Okay, so the guy said, okay, take the blood, okay, the report come out. Now, this is the result of the blood test, this is all the profile, everything is here. I ask you. That is a finding. But I will not tell you based on the report, you are healthy, you are not healthy, what do I think about? I never do assessment. But if you want to go into that, right, that's like audit again. Because that will involve conclusion. But this one will no conclusion, just a report only, everything passed. That is called agreed upon procedure. Now, so normally what we do that will involve this, you may not know but you might heard of this called due diligence. That's usually what we do before a person buy a company. They want to know whether the company is clean, got problem or not. Then they ask the auditor to check. That's called due diligence, okay? Which is agreed upon. Just to let you know what is that. Now then compilation work is for accountant. You see they change the word to accountant. Just like you use the auditor, right? Now it's accountant. For accountant to use accounting expertise, not audit. To collect, classify, summarize financial information. Now what is this actually? Compilation work is actually accounting work. Doing accounting work is called compilation. Now all these things are non-assurance. Okay? So I finish off assurance, non-assurance, and I've told you the 5 elements. Most important is the 5 elements and the inherent limitation. These are the 2 tested ones. Okay? So all done already. So today we have done chapter 1. Okay. So one thing to finish off is a question. Page 15. Okay, class. You see, this is a pass here. 5 marks. How they will test you. They say briefly explain the difference between positive, negative. So that's one thing they ask, right? Now the question says, explain me positive, negative. Then they also say, outline the advantages for directors to provide negative assurance on their cash flow forecast. So this question got two parts. So the first part is ask for differences. Second part is give advantages. So this question carry 5 marks in exam. So there's a short story lah. The story say the directors of Cool Enterprises would like to make application for bank loan. They want to borrow money. So they already prepare a cash flow forecast. So now you know what's the forecast. It's about future, right? To submit to the bank. Now they have engaged your service, being their auditor, to give them a negative assurance report on the forecast. Now you know forecast is prospective. We cannot give positive assurance. You cannot give reasonable assurance about future. But we can give negative. That's why when they ask you advantages of giving negative assurance, they are not asking advantage of negative. They are asking the advantage of why the forecast can make assurance. Because negative is already what we can. Okay? Now, so two things that they ask, 5 marks. Okay. So what we normally write here to get 5 marks, I don't want you to try, I just want to discuss straight with you. Okay. Now in the exam, anything you write, as long as they show me different, is also correct. For example, I ask you, outline the differences between me and Chandra. And then you say, oh, one is old, one is young. Okay? Or one got hair, one got no hair. One is Chinese, one is whatever. As long as the difference is still correct. Okay? So it doesn't matter which context the difference they tell you. So that's why, as long as I'm writing something that I can tell you it's a difference, the answer is correct. So what else can I write that can tell you the difference? Now I give you some helping hand so that you can use this in the exam. Okay, I can think of this. Now, can give a different name or not? What do you call positive, negative? Is there a difference? Now, or can you give the meaning or not? Or can you give example of engagement or not? Now, this can be any of the answer. So if you write all these things in, your answer becomes perfectly correct. Okay? Now, so in the exam, you don't have to write all that lah. You go straight to the answer but you use table. You use table, 1 column positive, 1 column negative. Okay, so I'm going to write like that. So I will ask myself, what's a name? Okay, positive is called reasonable. Because question asks you positive, negative, then I can tell the examiner positive is reasonable. Okay, now, so my answer will be, it is reasonable level of assurance. Keyword lah, positive assurance is a reasonable level of assurance. Negative assurance is a moderate or limited level of assurance. So different. That one different. Maybe half mark. At least it's still a different. Right? You can write that. Meaning, what's the meaning? That's why I give you the definition this time. How do you define positive? It's high but not absolute. That's how you define it. So I can tell the examiner that it means a high level but not absolute assurance. There's another point you can include in the answer there. Okay. What about negative? Now, negative, it means a level of assurance that is less than reasonable level. So a comparison is there. Now then they ask us, example of engagement like what? So I can tell them, financial statement audit is an example of positive assurance engagement. Then here I will say financial statement review ... It's a negative assurance engagement. Same thing lah, same word, just change it. One is audit, one is okay. And I told you again that how we show the level of confidence is the wording. That's why the wording very important. You always see that the question they will mention about the word, nothing has come to our attention. So that's the wording. So how will the conclusion be given? Now, we will say that an audit opinion is expressed by stating, in our opinion, financial statement give true and valid. Now, whereas here we will say a statement of negative assurance is given by stating nothing has come to our attention. Now I just stop here because the rest I gave you earlier. You write that, okay? Now you see, when I write an answer like that, I have already made comparison. Tell you the reason, okay? So you are reasonably expecting like at least 3 marks, 4 marks in the answer like this, okay? So that's what you do. So I just hope you see some skills on how you can write the answer. Okay, now not yet finished, because we only answered the differences. Question got 2. This is always the problem with students in the exam. We don't answer completely the question. Especially examiner asks 2 things in one paper. So the second part is what they ask you. Tell me the advantages. That's what they say. Tell me the advantages of having assurance for cash flow forecast. Now you think logically. You must think from the bank. They think from the point of view of the bank. If someone comes and say, I want to borrow money, and give you a forecast and say, now this is my forecast. A forecast got assurance and forecast got no assurance. Assurance means you are more likely to give them the loan because you feel safer. So that's where the advantage could come in. So the advantage that I can say include, now I would say, right here, advantages to cool enterprises. Now in the exam I will use heading. I'll just say advantages to cool enterprises. I'll draw a line. So I put number 1. Okay. Don't worry about using bullet list. Go ahead. You must use bullet list so that the answers become numbered. Then the examiner or the marker will make it easier to mark the answer. This is what we do at foundation level. Professional level cannot. Then I'll tell students you must write paragraph, long answer. But here is okay. We bullet them. Okay. The bullet but still write complete answer. Okay. Now I will just show example that the bank will find the cash flow forecast more credible and that would increase the chance of cool enterprises getting the loan. That's what I mean by a complete answer. You must write like that, but you use point 1. Okay. 2. So one more advantage I can say is the risk. Okay, risk. If you say you work in the Petaling Street, sell curry laksa, no document, no record, everything, nothing. But you got money, you got to borrow money. You go bank and say I want to take loan. The bank say can, but no record. Interest rate 8%. You work in office, you wear tie very nice, every month fixed pay one. You go to bank borrow money, can 6%. But in fact, the curry laksa earn more money than you, but the interest higher. Why? Bank will look at risk. Good document, low risk. So that could be another advantage. Okay. Now that bank would regard KOO as a lower risk borrower when it has quality supporting document. For the loan application. So consequently, it could get a lower interest rate. Then only its advantage. Now, so I just share you how I write. Again, exam strategy. Do I have to write all these things? You think passing is not 5 out of 5. Passing is 3 out of 5. So I always tell students you will be sensible and practical. You don't have to force yourself with all the answers. You think you have right beyond half, you can solve. So maybe I just differentiate them, put 1 point and tell me go on. Okay? Because in exam, more students fail because they cannot finish the paper. Because naturally, I think Asian, a lot of them have this problem. They cannot write a lot. So they go in, they keep thinking about what to write. So that is a problem. If you got no writing, then no writing problem, then good. Then you need points. Alright, but if you are those that you have problem to write answer one, then please don't stress to write everything. Okay? Now, so I finish off chapter 1, all done already. Okay? Now you can go back and run through again whatever we discussed. Now before we end the class, there are 7 objective questions here. So this is your section A, MCQ. Okay, I would like you to run through very quickly. We can finish this on time. You just run through and then choose A, B, C, D, which is the answer. Okay, give you a few minutes. Try this. Come, let's try. Now they say for the purpose of assurance engagement is to enhance credibility of the auditor's report. Is this statement true or false? True or false? Wrong, man. Don't need to pay fine. True or false? False. Why? Because it enhances financial statement, not auditor report. Okay. Now, B, number 2. Okay, nothing has come to our attention that causes us to believe that financial statements do not give true and fair view. Which of the following does not relate to this statement? A is limited assurance. B is engagement to review financial statements. C, auditors issue audit opinion. Now you know this is a negative expression of conclusion, right? So it's called limited. So correct is limited. Review is limited, correct. Then auditor issue audit opinion. We say cannot. If it's a negative assurance, opinion cannot be issued. Okay? So answer is C. C does not relate. Okay? Now which of the following is not an inherent limitation of audit? Now we go through this earlier. They say evidence is persuasive rather than conclusive. It has no time. There's inherent limitations in internal control and the auditor uses sampling. Now the answer A, C, D, correct lah. We discussed this already. So the only answer left which is wrong is B. Now 4. Okay, which of the following services are examples of assurance? Okay, financial statement audit, yes. Examine forecast, yes. There's prospective information, okay. Agreed upon procedure, no. That one, no. Okay, and compilation also no. So answer is 1 and 2. So answer is A. Okay, this can be a bit difficult because you may not know what is all these things. So you say, I don't know how to answer. But I just purposely put in to tell you. You don't need to know also you can answer. Because you just need to know what is wrong, then can. Now, which of the following constitute possible subject matter which may be evaluated for purpose of assurance engagement? Now, you see they are asking for subject matter. So actually what they are testing in this question, they are testing you the element of assurance. Because subject is one of the elements. So they gave us 4 things. They say which of the 4 here fall into subject matter. That means they are part of financial statement. Now, and you know one of the 4 are not. Okay, because the choices is 1, 2, 3, there are 3 options. Now, which one is not? They got data, processes, IFRS, and governance. Now, I just want to tell you why the answer is wrong. IFRS is the wrong answer. IFRS is accounting standard. Accounting standard is not subject matter. Accounting standard is the criteria. That's why if you understand the 5 elements, you know which is the answer. Okay, but you may not see how to apply, but now you understand it. So that is because this is the criteria. So the answer is 1, 2, 4. So B. Okay, next page. Criteria. Okay. Okay. Which 2 of the following describes the role of responsible party? That means director, director's role inside assurance engagement. Now, 1, they say they set the criteria. 2, they gather evidence on the subject. 3, they issue opinion. 4, they prepare the subject. Now, of course, issue opinion is not your job. It's the practitioner job. Prepare subject matter is your job. Now, then left with 2. They set the criteria or they gather the evidence. Now, we don't gather evidence. We prepare. And to prepare, we must know the criteria, right? That's why we set the criteria is correct. Gather evidence is wrong. So answer is 1 and 4. So answer is C. Okay, last one. Sorry, this answer repeated. So you just cut one of the answer. Just cut off A. So this become like 1 mark question. You have 3 options to choose. Okay. Now, in reasonable assurance engagement, how are assurance provided and the conclusion given best described? So they give you 3 options. High and absolute, high and positive, limited and moderate. So reasonable should be which one? High and positive. There's no such thing as high and absolute. And limited moderate is not for audit, it's for review. Okay? Now these are all the answers to the 7 options. So you realize all these things are what we discussed just now. Okay? So in the exam you might have like one question come out in section A from this kind of area. I give you some indication. So I hope today class introduce you a bit about auditing, some concept, and I'll show you some writing question, how to do, how to write, and some objective. Okay, so we'll end here today. Now the next class is this weekend. We have a class this coming Saturday. Okay. Sunday. Okay, I'll see you on Sunday. So it's a very long class, but we have very little students. So maybe I foresee I don't have to go so long. Okay, because less students can usually be faster. Alright. See you again this Sunday. Class is 9, right? 30 or 9? 9. See you at 9 o'clock. Okay.